Hi everyone, it's me, your Manu Issue, and welcome back to my YouTube channel Manu Issue ACCA classes. So in this video, we are going to deal with the Cherry Company question, and this is from the BPP kit of F5. So if you are watching my video for the first time, don't forget to subscribe my channel as well as to hit the bell icon. Okay, so question first requirement is what would the minimum transfer price per unit of product X be if it sold 12,000 units of X, assuming that the capacity for 15,000 units. Okay, so just wait, I will create a new sheet. Okay, so question is basically asking what would be the minimum transfer price per unit for the product X if A sold 12,000 unit to the buying department, assuming that it has a capacity of 15,000. It means the let's first read out the question, then I will make it a bit clear. Cherry company has a two independent divisions. So company have a two division. We got to know. So division is one is A and B, other is B. Division A produce product X and B is a new division which produce a product Y. So product produced by the division A is X and by B is Y. So last year A sold X exclusively to the external market, means whatever the product has been manufactured by the division A, it has been sold to the external market. Management at a Cherry company did not wish to disrupt the operation of A as B was experimental division. However, due to success of product Y, B now permanent division of a Cherry company. So means the B division was just for experiment one, but however the product which has been manufactured by the division B has been sold, and so a good response, as a result of which management had decided now division B should be considered as a permanent division of the Cherry company. So management wants the A to provide at least some units of product X to B. So now what the management has decided, now the division A which produced or manufactured the product X should also produce a some unit for the division B. Okay, so table below show contribution margin for the each division when B purchase X from the outside supplier. So contribution margin have been shown for the each division, and now B was uh, purchasing the X product X which is used in manufacturing the product Y has been purchased from the outside supplier now, but management had decided that division A should also manufacture some unit of X for the division B. Okay, so now selling price for product Y is right now 37, sorry, 150, and for the product X is 37, right? And this is selling price per unit. Okay, so variable cost per unit for the product X is 30, and for the product Y is 65. Note here, has question has told division B does not include the cost of X, means whatever the cost or selling price charged by division A for the product X to sold it out to division B has not been included in this cost. The question has mentioned this. And the cost of X purchased from the outside supply. So cost of X in case what the company division B was earlier purchasing the product X from the outside supplier, in that case its cost was 35, right? So cost of X purchased purchased from outside suppliers. Okay, so it's gonna be cost division be 35, right? So now division B is no more going to buy this product from the outside supplier, because division A is going to manufacture some of the unit for the division B. So what is the contribution per margin? So contribution uh, margin per unit for for the X is 50, no, no, 7, right? And for the B is 50. Be careful here, I mean in question it has been altered. B has the information regarding B has given the first, after that for the A division has given the in the given after the B. Okay, so we know the contribution margin. Anything else we left? No, we did it all. So coming to the point, what the question has asked, what will be the minimum transfer price? Now the division A will manufacture some unit of X for the division B. So what would be the transfer price that would be charged by division A for the B? And now more things, more information that has been attached in the question is that it has told that division A sold 12,000 units, okay, but its capacity is of for 15,000 units. It means the division A have a some spare capacity. So we do have two cases. In book you can find the three cases, but now I will talk about two cases. One in case of a spare capacity and one in case of a full capacity. Okay, so if the division has a spare capacity, if the division selling division if selling division has a spare capacity, again I repeat, selling division spare capacity in selling division, not buying. Okay, so if spare division selling division has a spare capacity, now in our case is division A and is having a spare capacity of 3000, right? In that case, the whatever the price that would be charged by division A for the product X to B, it will be equal to the marginal cost of the selling division. Okay, so what is the marginal cost that has been occurred to division A for product X? It's marginal cost means the variable cost, and the variable cost is 30, so it will be 30. So the minimum transfer price that will be charged for the product X by division A to B is 30, because the division has a spare capacity. In that case, the transfer price will be equal to the transfer price will be equal to the marginal cost of the division A. Okay, so now in case of no spare capacity, means full capacity has been utilized, what will be the transfer price in that scenario? In that case, the transfer price will be the marginal cost plus the contribution that has been lost by contribution lost by division A. It means if division A would not sold this product to B, in that case it will sold this product externally. In that case, whatever the contribution has been lost due to not selling to the external because of internal sale, so that would also be added in the marginal cost and to determine the transfer price. Okay, so if we will find such kind of question, it will make you a bit clear. So right now just understand, in case of a spare capacity, the transfer price will be equal to the marginal cost of the selling division. Okay, moving ahead, next question is, what would be the minimum transfer price per unit of the product XB if A sold 12,000 unit of X, assuming that has a no spare capacity? So now the no spare capacity question has been came, so now it will be more clear to you. So what would be the minimum transfer price per unit of product XB if A sold 12,000 units of X, assuming that has a no spare capacity? So again the division A is going to sold a division B the product X of 12,000 units, right? But the now there is the whatever the capacity the division A have, it's fully utilized, so there is no spare capacity. So what would be the marginal cost, I mean transfer price? It will be equal to, I told na, marginal cost. Marginal cost means variable cost, all variable cost of the related to the product. In our scenario it's 30. And what is the lost contribution means, if the division A has not sold this good to division B, it could be sold externally. And what is the selling price of this product X is 37. Division A is selling this product externally at 37 per unit. So we will subtract our all the variable cost related to the product, it's again 30. So 30 or you can directly click on the contribution, so it will be equal, so it's 37. So it means the minimum transfer price for product X will be 37 in case of company has no spare capacity. Okay, moving ahead, next question: if there was no external market for the product X, which of the following approaches could be used to negotiate a transfer price? So see, there are two methods to calculate the transfer price. One is the market based approach and second is the cost based approach. So in case of market based approach is for wholly if whatever the price of the similar goods available in the market, we can use that. But in if, what if in case there is no external market for the product or services, in that case we will move to the based approach, where the transfer price could be calculated either using the full cost, marginal cost. Okay, so but be sure we will take the standard cost, not the actual cost. Okay, and here you can find that if there is no external market for the product X, then the transfer price will be based on the full cost. Okay, okay, next. Are the following two statements about Cherry Company true or false? Okay, Cherry Company transferring price system should seek to establish a transfer price for the X that will be provide an incentive for the manager A and B to make and sell quantity of the product that will maximize sales of product Y. I will repeat. Cherry Company transfer pricing system should seek to establish a transfer price for the X that will provide an incentive for the manager A and B. Yeah, up to this is correct. To make and sell quantity of the product, okay, that will maximize sales of product Y. No, actually they will, it is obvious that they will set a transfer price that will provide a incentive to the both manager to make and sell quantity of the product that will maximize not the sales but the total profit of the company. Okay, so this is the like point where we make a mistake. It's not about the sales. Overall, in transfer price, one of the objective is goal congruence. And what is the goal congruence? That whatever the price will be set by the division, that should be the aim should be to maximize the company total overall profit, not the division profit. Okay, so this one is false. Coming to the second, the manager of division B is likely to be more motivated if she is given a freedom in which to operate and is able to purchase from the outside supplier if prices are cheaper. Obviously, if the division manager of division B are getting the product X at cheaper rate from the outside, then obviously it's going to purchase it from the outside. So it will motivate and give them freedom as well. So this is true. Okay, so next, are the following statement about Cherry Company true or false? The performance of the manager of A and B will be easier to assess in environment in which managers are able to control greater element of the business. The performance of the manager of A and B will be easier to control. Sorry, it will be easier to assess in the environment in which managers are able to control greater element of the business. Okay, so obviously this is true because if the in environment where the manager can control, first thing, the principle of controllability told the performance of managers should be assessed on the basis of the area or the factor which are under the control of the manager rather than the area or factor which are not under their control. Okay, so if the managers if the elements or the whatever the elements in the environment are under the control of the manager, it will be quite easy to assess the performance of the manager. So this is true. So second, in a competitive market, it is likely that supplier will offer a product X to division B significantly cheaper than division A can for a sustained period of time. So this is about the first scenario where the perfect market exists. If there is perfect market, in that case, what happened? The uh, selling department have to sell sell the product at the what external market price. Okay, but one thing that what is the objective of the transfer pricing? Goal congruence. So to maximize the profit, right? So if the in competitive market, if the buying department buy the goods from the division within the organization or the division who are selling the goods, in that case there are few costs which will be saved. Example, packaging, your what is called selling cost, this shipping cost, it all will be saved. So it will be like benefit, we can say it will be beneficial for the company or for division to buy those products from the within the organization rather than from the outside supplier, because it will save the shipping cost, packaging cost as well. So that's why it will not be cheaper to buy from the like outside supplier. In case of competitive market, it will be good to buy from the division, because it will save the packaging cost and shipping cost, and which will beneficial from the overall company point of view. I hope you got my point. Okay, so in next video we will do the Zomato company.